I'm happy to share that once again, Mr. Hakimian is joining me here today. He is the founder of Tolou Capital Management. Mr. Hakimian, thank you very much for taking your time to have a chat again.
Thank you for having me, Elia.
As usual, we will focus more on economics than on finance because that is my area of expertise. The first topic that we will talk about today is the economic data that was released recently, more specifically, the inflation and labor market data. Mr. Kimian, let's just start with the inflation data that was released for May. The PCE report was quite favorable. I also have my own index, which I call the one standard deviation lower band inflation index, which measures how close the month-on-month changes in various inflation metrics are to their respective one standard deviation lower band. And if you look at the 6-month moving average of that index, it seems like we could be back on the disinflationary track. So the inflation picture was quite favorable for May. How has your outlook for the US economy and interest rates changed based on the released inflation data?
Core was essentially like 2.5, 2.6% year over year. So we were, let's say 150 basis points above target. Now we're 60 basis points above target. The nominal personal income numbers were pretty strong at 0.5% month over month, which is like 6% annualized, not indicative of any recession if you were to ask me. And real personal spending, because you got that really low, you got that really low prices growth, that real personal spending was 0.3% month over month, which is almost 4% if you annualize that number. So, I mean, I don't think my thoughts have changed too much. It's the economy is strong. I don't believe we need rate cuts. Even if we do cut rates, I think it would be something like a tweak, kind of like what the ECB is doing right now. As an example, Lagarde continues to say that although we cut once, this is not a commitment to a cutting cycle. This is more of a tweak around the edges, just a tweak policy. So, as of now, and of course these things could all change, but if you were to ask me as of now, I think the Fed should be cautious in terms of cutting. Not that we are in an emergency mode like we were in 2022, or I'd even argue in late 2021, but they missed that. So now that they have to, they should be cautious with cutting because why cut? I mean, if the economy is doing well and inflation is going down on its own, why? I mean, why not save the firepower for when you actually were to need it? And you are going to eventually need it at one point. And just to hammer at one point, I know it sounds like a broken record every time I come on this segment, but when you're running a 7% fiscal deficit to GDP, that is a lot of stimulus on its own. That's a lot more stimulus than the 25 basis point rate cut would be. A lot more. I think it's not what should be happening, but we have to play the hand we're dealt, not the hand we want. And the Fed has to realize that fiscal is essentially acting as a rate cut or a stimulus, or however you want to call it, to consumers, to businesses, to private entities. So the necessity to cut rates is probably a lot lower than if, let's say, as an example, we were running a 2% deficit to GDP, which is more historically normal. So that's my main thoughts on that topic.
So I think it's a great point that you're making here about the large deficit, of course, that the US government is currently running. But I would, at this point, ask the question of, don't you think it would be wise for the Fed to at least start lowering rates in order to make sure that, in order to maximize the chance of still achieving this soft landing? So do you think that there is a chance, based on the developments we have seen in the labor market, especially, continue to come into better balance, job openings continue to fall, they ticked up slightly in May, but don't you think that there is a risk that sort of the slowdown we're seeing right now could turn into a non-linear slowdown? It could, pick up in speed, and that would require way more rate cuts. So don't you think it would be wise for the Fed to start lowering rates now to really ensure that they could still achieve that soft landing?
Is there a risk that we are too late? Of course there's a risk. You know, it's probably actually going to happen at the end. That's probably what will happen. We'll be late and it'll cause more cuts at a faster pace than otherwise probably would have happened. But then again, if you just go back to December of 2023 or November of 2023, this was kind of the thinking, right? Powell got very dovish in that November and December Fed meeting, and he basically telegraphed that they were going to cut rates. They telegraphed 3 rate cuts. And what happened is that bond yields shot down, asset prices shot up, home prices rocketed up, hiring picks up, and inflation ultimately ticks back up. And what ended up happening? We're already in July. It seems like there's no chance we're getting a July cut, so that earliest we can get a September cut. We're probably going to end up getting a less cut than even the Fed had forecasted last November. And I'd argue it's because we keep making this mistake of in advance saying what we're going to do if the job market cools off or if inflation cools off. I think everyone that's dealing in capital markets is intelligent enough to realize that if we get a negative job print, yes, we're going to end up cutting rates, of course, right? We're not going to keep rates for no reason if we're losing 100,000 jobs a month. But that being said, and I don't even think this is an opinion at this point, Frank. I think this is just what happens when when the Fed preemptively starts signaling cuts. Well, then the market prices it in, and then what you want to do, let's say in a quarter's time, you're doing immediately because the 10-year shoots down 40 or 50 basis points right away. Everything gets hot again, and there you have it. And mind you, that actually, in a strange way, allows the government to spend more because they are borrowing at market rates. If the 10-year goes from 447 to 380, as an example, well, they get to borrow at 380. It's not as expensive to borrow at 380. So you're also adding the fiscal thing on top of it. And I think these things are all correlated. If you look at the CBO just released some data, their projected deficit for 2024, they raised it by almost $1 trillion. I mean, they made that projection 6 months ago, and they already think it's close to $1 trillion off. I mean, this is like, it's just very hard for me to see a scenario where this thing slows down on its own. And yeah, I hear the argument of why don't we just preemptively do it, but it hasn't worked. And it's now been like 4 or 5 times that we've in this 2-year cycle that we've priced in rate cuts, that Powell, to one extent or another, sometimes pretty explicitly, sometimes subtly, endorsed a rate cutting cycle being imminent, and it just keeps getting delayed. I just don't see the usefulness in this. I don't see the usefulness in a volatile bond market. As an alternative, I suppose one thing that they could do is they could say, all right, this is what we would do if we would do X if Y happens. We would do A if B were to happen, and they could put out some different scenarios. I know that's something that they've been somewhat considering as of late, maybe putting out a range of possibilities in regards to monetary policy rather than giving just one dot or something. But it is what it is, and it would not surprise me if we cut in September, and it also wouldn't surprise me if it ends up being a mistake when we look back on it in April of 25.
Absolutely. So you would say that in general, and I know we talked about this before, that the Fed pivot we saw in December had a inflationary effect at the end of the day.
I mean, I don't think you can argue. I mean, look at the first few months of 2024. Inflation was ticking back up. Bond yields had to go back up. And now that bond yields went back up because we took out those rate cuts that we priced in, now that we went from pricing in 8 to pricing in 2, now activity is slowing down a little bit because, you know, rates are at 450 again, and short rates are at 5 again. So I don't even think it's much of a debate. I just think it's the empirical observable data that we've just seen time and again in this cycle.
Okay, so it does seem like you are very much aligned with what Jay Powell is basically thinking, the way the Federal Reserve looks at the economy at the moment. I know there are some economists out there like Mohamed El-Erian, for example. he always differentiates between what he thinks the Fed should do and what he thinks the Fed will actually do. And in his opinion, the Fed should cut at the July meeting. I'm just curious, is there any divergence in what you think the Fed should do and what you think the Fed actually will do? And in your personal opinion, do you think that at the September meeting, it would be appropriate to lower rates?
My personal opinion is it won't be.
Okay.
So my thing has always been that I would lower rates if I was a voting member on the FOMC. The biggest thing that would cause me to lower rates would be a negative job print, because income is going to cycle through the spending and it's indicative of falling corporate demand and whatnot. But I mean, so if you think about what the Federal Reserve said at Jackson Hole of 2020, it was in 2020, they basically changed it from a strict 2% inflation mandate to 2% over time inflation. Needless to say, from 2021 on, we did not have 2% inflation. We did not have an average of 2% inflation. So would that be the worst thing in the world if for a few months, at least, we were experiencing positive payrolls with 1.6% inflation? Would that be the worst thing in the world? I mean, that's still technically within their own mandate because we had 6% inflation in 2022, right? So that means even if we had 0% in 2025, that's almost an average of 3, depending on the other numbers. And I'm not endorsing that, but all I'm saying is that if oils are positive, if corporate profits are positive, if house prices are going up, if asset prices are at all-time highs, if unemployment is literally at 50-year lows, is it the worst thing in the world if we just let inflation cool down a little bit more before we start cutting? Because once we start cutting, we will probably get some inflation back, right? So is it the worst thing to have a little bit of a cushion? And I know I might sound contrarian on this, but I just don't think we should be cutting until we have to cut. And then when we have to cut, we'll cut. But this idea of it's just flat out wrong to me that we should tweak it in advance and try and be our track record as a country with trying to get these things the last 5 years has been atrocious, outright atrocious. We should take a little bit of humility and say that we don't have to preemptively do these kind of things to do anything. And again, I'm not saying wait until we're in an outright disaster to start cutting, but I think we have to see some sign of something that needs more support than 7% fiscal deficit to start cutting. I just think, and if we don't, I think, but then to answer your other question, I think the Fed probably will cut in September. And my thoughts are actually a little political on this, that if they don't cut in September, they may end up cutting in either November or December after. So November and December, both the meetings are after the election. September is the last meeting before the election. So they're kind of in a jam right now because if they cut in September, half the country will say that, oh, you're cutting to help Biden. And if they wait until November and December to cut, they're going to say, oh, you wanted to cut, but you waited to either hurt Biden or to help Trump, however you want to put that comment. So they're in a tough spot. I think they'll cut in September. I also think they'll cut in either November or December. And I think economic activity is going to pick back up. And I'm not sure if they're going to hike again, but I doubt they're going to have to cut further than that. And in the long run, it'll probably end up being a mistake because it'll have been 50 basis points of ammo that could have been used when an exogenous shock that no one can predict will inevitably come. And all that means is that since we're going to have less room to cut rates and less room to stimulate via monetary, we're going to have to do unorthodox monetary policy, which is otherwise called quantitative easing, buying mortgage-backed securities, all the things that we did in 2008 and 2020 that arguably led to this mess. We'll probably do it again next time too.
So it sounds like you believe that even reducing interest rates now by, let's say, 25 basis points would not significantly reduce the chance that we see a significant slowdown further down the road. When you say that we might have less ammunition to cut rates if we then end up seeing a recession.
Well, first of all, 25 basis points is pretty marginal. I mean, okay, the 25 basis cut move. So mortgages go from 7.5 to 7.25 maybe. Does that suddenly, materially change activity? Probably not. Um, and second of all, oftentimes what happens that causes, these deep contractions, it's exogenous. It's a COVID. It's a 2008. It's a September 11th. It's a Black Friday in 1987. It's nothing that you could have predicted before, which is why it makes it hard to play it right. Um, and when they happen, they're really severe and they require a lot of help. So I just think, why limit the amount of ammo you have now when things are well, when historically, you know for a fact, there's going to come a time in the next 5 to 6, 7 years where you're going to need ammo. And why not save it for then when it'll actually be effective, so you don't have to do these unorthodox monetary policies that led to this inflationary boom around the world. That's just my personal opinion.
Okay, that's definitely an interesting take. And at this point, maybe just the last question for this segment. Is your base case that we will end up in a recession as a result of this tightening cycle?
Well, my base case is that we will end up in a recession because every cycle ends in a recession. So a recession is inevitable. One reason why I'm never 100% in stocks, because it's just pretty bad risk reward, because you know that you're going to lose 50% of your money at least once or twice a decade. But would I explicitly say that like there's a clear path I can draw from this tightening cycle that will imminently cause a recession in 24 or 25? No, I don't think, because I mean, look, we've already been at 5.25 since last July. And, we've had almost 3% real GDP growth for a few of those quarters in this past year. So, I mean, any effect of monetary policy would have transmitted by now. One counter argument that I definitely could make, that I could see this tightening cycle eventually causing a recession, is one, as the lock-in effect on mortgages gets smaller, which basically means that, the average mortgage rate in the country right now is 4% because people refinanced or they bought prior to 2022 or whatever it might be. So they're not exposed to 7.5% mortgage rates. But that was the average mortgage rate was 3% a year ago, and it was 2% a year prior. So every year, every 6 months, it goes up because one, those old mortgages mature and they have to be refinanced at market rates. And two, of course, any new house that is bought in America is bought at existing rates. They're not bought at old rates, except for those small percentage of assumable mortgages, but that's a very tiny percentage of mortgages in America. So that lock-in effect over time diminishes, and that leads to mortgages, which is the main way that monetary policy transmits in this country, to being more close to what monetary policy intends it to be. And obviously that could actually cause, yes, I'm not unreasonable. If the average mortgage goes from 4 to 7, that's going to slow down consumer spending. Duh, right? So that's one way I can see it. And another way I can see it is that starting in 2025, a lot of high yield, aka junk borrowers, borrowed in 2020 on a 5-year term, and a lot of their debt comes due, debt that they were paying, let's say 300 basis points above treasuries. Back then, treasuries were zero during COVID. So they were paying 3, 4, 5% around there for debt. Now they're going to have to pay 8, 9, 10% for their debt, depending on their credit quality. And of course, that is another way, because, there are a large swath of employment in America. And if they start paying 500 basis points more for their funding costs, they're going to lay people off. So to an extent, or the higher less, one way or another, and that will cause a slowdown. So those are two things that I'm looking for in terms of a slowdown. They're not imminent, and I always say being early to a recession call is as wrong as I mean, it's as wrong as being wrong. I mean, imagine the people that were bullish on the recession call going into 2023, and they literally missed the best year in Nasdaq history since the dot-com bubble. I mean, just it's as wrong as being wrong. So if they were 0% stocks and they were loaded up on TLC, they're doomed. So I think it could happen a recession from this tightening cycle. It's not imminent, and I'll be the first one to say it. I'll be writing about it on my Twitter, on my LinkedIn. I'll be putting it everywhere if I see some signs of it, but I don't see it yet.
Okay. So given that you expect this economic resilience to persist, and given that you expect interest rates to remain elevated throughout this year and probably also going into 2025.
Well, sorry, I expect interest rates to go down. I mean, if I was in charge, I would leave them elevated, but I expect, with like what El-Arian likes to say, and I have a lot of respect for Mohamed El-Arian, that I think they should stay elevated, but I believe they'll be cut, if that makes sense. What I think the Fed should do versus what they will do is two different things at the moment.
Okay, so where do you see the federal funds rate given your outlook, let's say mid 2025?
It's 25, 475, 450 to 475, I would say.
So you definitely expect a slow cutting cycle.
Yeah, because I mean, there's going to come a point where if they cut it too much, it's going to lead to a disaster. It's because all that lock-in effect is gone. If they cut rates to 2.5%, and you can get a mortgage at, let's say, 5%, there's no lock-in effect anymore because any new homes are going to be bought basically at market rates. And two, that high yield refinance issue that we were just talking about would be greatly diminished. So, and for what it's worth, I think that would be pretty inflationary. On top of the fact that it doesn't seem like either candidate really cares about fiscal deficit. And, it looks like right now the front runner is the challenger. It's not the incumbent at the moment. And the front runner is pretty gung-ho on tariffs, which are just, unequivocally inflationary. I think there's a scenario where if monetary policy were to get too loose and everything that fiscal policymakers want us to do were to happen, which is a big if, but if it were to happen, we could totally have another inflationary episode, especially if we're still running 7% fiscal deficit. So I think they'll tweak it for the sake of tweaking it. And, that's a problem if you ask me, but it's not like, oh my God, this is a mistake. I think cutting the 2.5 would be a mistake. And, thankfully, I don't think Mr. Powell wants to do it. I mean, this morning in Portugal, he basically said that the consensus on the committee is that they don't think, those arbitrarily low rates are going to come back. And they kind of are thinking that R-star may be a little bit higher, although they don't want to explicitly endorse that yet. And I understand that. Those things take time to, for a legitimate body maker to say something like that. I understand why they want to take their time on that.
Yeah, absolutely. I mean, R-star is such a hypothetical topic. I also wouldn't really put too much emphasis on it if I were the chairman. You talked a little bit about the upcoming election, and sort of there are two questions I have about treasury yields, and especially the 10-year. So my first question would be, given your outlook for the economy, given your outlook for inflation, where do you see the 10-year treasury yield, let's say, at the end of this year? And in addition to that, of course, after the debate between Trump and Biden, we did see treasury yields at the longer end of the yield curve rise a little bit because I guess of the expectation that Trump will impose tariffs, for example, and that will be inflationary to some extent. So given those two factors, your outlook for the economy and the potential for the challenger to to win the upcoming election. What is your expectation for treasury yields at the longer end of the yield curve?
Just want to preface all of this by saying this is the first time we've spoken politics on this podcast. I'm a registered independent. To be frank, I dislike both candidates. I have no issue with anyone that likes one or the other. It's not so significant to my opinion, but yeah. First of all, where I see treasury yields ending 24, I think we're going to have the 2-year move a little bit down towards like 475 to 450 in that range, because once the Fed is cutting, it's very hard to keep the 2-year at 5 if the Fed funds is 475, because you're essentially at that point betting on a tightening cycle, because that would mean that the average of the Fed funds over 2 years that's currently at, let's say, 4.75 would have to average 5 for the 2-year to be 5, which means you're expecting 50 basis points of tightening over the next 24 months to get that 5% average. So I think the 2-year comes down with the cutting cycle, and I think the 10-year stays flat at around 450. And that's because the 10-year is more of a reflection of growth and inflation and bond supply and fiscal policy. It's a lot less dependent on just outright like immediate monetary policy or Fed funds. So I think the yield curve steepens a little bit. I hope it's not a bear steepener, because that's what we've got in the past few days, which, by the way, is exactly what I thought was going to happen, and I think it's appropriate. I think the bear steepener is, given the front runners' policies, given Trump's policies, I think a bear steepener is an appropriate. It's basically the same fiscal policy as Biden, 6-7% fiscal deficit, but you throw tariffs on top of it too, and he really wants the Fed to cut rates. And I get why he wants to do that, because he wants the economy to be hot, because that's all that, elected officials care about. They just want to win in every 2-year cycle. And they hope that they can hold off inflation long enough so that inflation starts with the next guy's term, and they don't get to take any, they don't get any blame for it. So I think the bear steepener was appropriate. And I think we're going to probably be in some kind of world where the yield curve eventually is going to normalize. If it normalizes via a bull steepener, it's a lot more bullish for risk assets like stocks, commercial real estate, homes, and whatnot. If it's a bear steepener, it's tough. It's going to be rough. A bear steepener was roughly what happened in 2022 when the Fed finally gave up the transitory idea, and it was tough. Nothing worked. The only thing that really worked was dollar versus other G7s. I have a position on the dollar versus the euro, because I think we can have a bear steepener. It would be a bigger position for me because I think it would work, but I'm a little bit worried about, a lot of people in some potential second administration have said that they support a devaluation of the dollar, a weaker dollar, and obviously a weaker dollar means you don't want to own the dollar. But I think the market reaction initially could be a little bit different than what would happen if they were to devalue the dollar. And that's probably a topic that we should talk about in our October call, because we'll be a lot closer to the election at that point. And, their stances will be a little bit more concrete at that point. But needless to say, artificially altering FX rates is a disaster of an idea. We are the reserve currency in the world, for now at least. One of the reasons is that we let our currency float, and the market gets to decide. We don't get to decide what our currency trades at. It's really bad if you start either devaluing or revaluing our currency that's not a good sign. So, but that's a topic for another time. It's too early to speculate on any of that, but that's just something I've been thinking about. And um, was your second question about the best? I mean, did I answer that, or you want me to elaborate on it further? Or
No, I think you answered it mostly, but you started talking about the US dollar, and I would like to, yeah, I mean, maybe bring a slightly different perspective to it very quickly. If you take a look at Europe at the moment and the political uncertainty that's going on in France, for example, the widening spread between the yield on French bonds and German bonds, if that political uncertainty persists, and let's say that spread continues to widen, and maybe the ECB might have to step in, right? And maybe even lower rates more aggressively or use another intervention tool to minimize the effect of that. So, given the political uncertainty in Europe, your outlook for the economy, your outlook for inflation, your outlook for what the ECB might do, how do you think that could affect the strength of the US dollar, especially compared to the euro? Just the situation in Europe and what you expect the ECB to do. Just mostly focusing on the interest rate differential between the US and Europe.
I wish I could answer that question next week after the round two of the French elections are done. Because as an example, last Sunday, the Sunday that just passed, um, obviously Le Pen's party, the right to far right party, won by a pretty large amount, but it did slightly worse than was expected. And because of that, the euro actually rallied in the Asia session. So I would wait to answer that question after I see the results of the French election. And also, Le Pen's party has never governed. It's been a theoretical party its entire life. And now that they have to govern, there's some soft hope, and let's see if they turn out to be true or not, that they'll govern more rationally than they campaign. As an example, they've slightly backed off the Brexit idea. They've kind of explicitly endorsed staying within the EU currency. So these are obviously all things that are obviously bullish the euro. And if they were to become more extreme, then it would be something that's pretty bearish, the euro, obviously, and that would help my dollar thesis. And I just want to wait and see the results. I want to see two things. I want to see the results first, if they get the supermajority or if they just get a majority, because that affects how much they can impose their will and also impose what their voters want. And then number two is I would maybe naively, but I would give them the benefit of the doubt to just see how they govern relative to how they campaign. Because, and if it's not clear enough, I don't really support their policies. I don't support far right or far left policies. I'm pretty centrist myself. But I would give them the benefit of the doubt just to see if they govern a little bit more pragmatically than they campaign. Because if they were, then it's probably something where it could be manageable, especially because Macron will stay as the president of France up until at least 2027. And it's probably just something that's too hard to discount that far in advance if it was not, if it was to be some kind of split government, for now at least. So I guess I'll see. But yeah, I think the outcome where you get an extremist government in France is very good in my position in the dollar, and it's very bad for Europeans, unfortunately. I would surmise.
That's a great way of summarizing this. Mr. Hakimian, we have around 2 minutes left here. So maybe very quickly, one question on small caps. I know we talked about this last time, but now especially given that you expect the 10-year yield to remain elevated, given that you expect a bear steepening potentially, how will that affect the potential rotation to small caps? I know we have been waiting for that for quite some time.
If you get a bear steepener, you don't want to be in a small cap. I'll tell you that. Absolutely. They have a lot of variable debt, and they're just going to get rocked if there's a bear steepener. But then again, so will large cap tech. I mean, if equities are just not what you want to own if there is a bear steepener. And obviously, I would not sell my equity position because I could be wrong about that bear steepener. I don't want to pay if I'm wrong, but I wouldn't add to an equity position if I was to assume that there would be a bear steepener. And look, I might sound a little bit, controversial here, but I don't think the difference between small caps and large caps is all that different. They're like 94% correlated or like 91% correlated throughout history. It's not you're not going to diversify your portfolio by switching from small caps to large caps, right? If you want to really diversify your equity portfolio, you have to either own short bonds or you have to own gold or you have to own oil if it's an inflationary world, or you have to own the dollar and short something else. But you're not diversifying your equity book by switching from long caps to short caps. So I don't even think about this topic too much because it doesn't pay enough. There's not enough alpha in the idea to focus on it so much. These are like minor cosmetic differences to a portfolio if you're in large or small. For my exposure for equities, it's generally just large cap tech, and it's not, an expression of an opinion on the asset class, but it's just that my personal portfolio has it's so convex to protect against the downside that I have to own for the upside part of my portfolio. I have to own what does best in that environment because I have to participate in those rallies. Otherwise, I would underperform the market over time, which for me has just been large cap tech and a very small allocation to Bitcoin. And small caps tend to outperform within the equities when there's a bear market, but they outperform in relative terms. Like as an example, if large caps were down 30%, small caps would be down 20% or 25%. And that's just not what I consider diversification. When my large caps are down 30, I need the other rest of my book to be up by 25. I can't have it be just down 20 and think I hedged something. I didn't. So that's my main thought on that. And I don't think about it all that much. I take it as a sign of some stuff. But I don't really think about it all that much because I don't think it's actual diversification.
Absolutely. So maybe just as a last point here, if you're, I don't know, an average investor, what would you recommend at this point in the cycle? What would be your investment recommendation?
Average investor, my recommendation is always going to be something that is very simple. It's hard, but it's simple advice. The words are pretty simple. Build yourself a portfolio that is truly diversified from one another. And that doesn't mean long short. That doesn't mean owning tech stocks and owning oil or, owning real estate stocks. Build some type of portfolio for yourself that when asset A in your portfolio goes down, asset B goes up. And, I don't want to lead a horse. I can own, I don't want to do all the work for everyone because if you teach someone how to fish, they'll have food for their whole life rather than if you give someone a fish. But I would focus on building a portfolio of 5 to 7 asset classes that are truly an asset, not being short, an actual asset class that is truly uncorrelated from one another. It could be gold and long bonds. It could be short rates and stocks. It could be oil and government bonds. It could be whatever you want it to be, but it has to be truly diversified from one another. And that is the easiest way to build out a portfolio that will help you sleep well at night. And what I would say to individual investors too is do not own individual stocks. Do not do it. You have less than a 30% chance of outperforming the S&P 500 owning any individual stock. All right. The worst investment strategy in the world is to have a portfolio of 20 individual stocks. You're going to underperform, man. You're going to underperform big time. Okay. The second worst portfolio for any individual to have, and it's actually a pretty good portfolio, so I don't want to call it bad, is to just own the S&P 500. At least in that case, you're guaranteeing your 10% return over time. At least you're going to guarantee that much. The best portfolio to have over time is to have some type of balance between the asset classes so that you are earning all the different risk premiums that the market affords in an uncorrelated fashion, and you're smoothing out your volatility. And even if you don't outperform the S&P 500, you're doing so with a lot less risk. So when your friends are down 50% in 2022, you're down 8%. When your friends lost 40% in March of 2020, you lost 4%. When your friends lost half their money or more in 2008, you lost 15 to 20%. So that is the main advice that I would give. And it does not have to be hard, and do not make it harder than it has to be.
Thank you for that. And maybe as a last question here, would you recommend staying away from the long end of the yield curve, given your outlook for bears? Just stay away.
Yeah.
Okay.
I would stay away from it. If you want to own rates, own the front end, own twos. Don't own the long end. You can get smoked. If the 10-year goes back to 5, you're hit over there. And if the 10-year falls, guess what? Gold, stocks, those are probably rising if the 10-year were to fall, right? So it just doesn't seem like when bonds and stocks are correlated, there's no reason to own bonds, long bonds, if you were to ask me. If you want the coupon in the front end, I totally understand that. If you want to put money in a money market fund at 5.3 and don't take duration risk, don't take inflation risk if you want. But I wouldn't own the front back end of the curve.
Yeah, okay. So then as a very last question, do you still think that there is a lot of money parked in money market funds right now at the shorter end of the yield curve that will also potentially boost equities once the Fed starts lowering rates?
It's $6.1 trillion. It's at a record high. Well, if the Fed starts lowering rates, I guess it kind of depends for what reason. Because if it's something scary happens, then stocks are going to go down, which means people might keep their money in money markets even if they're just paying 1. But if the Fed was to cut from 5.25 to 4.75, I think people will still keep that because that's still a pretty nice return you can make on your money for literally no risk. I mean, you're just betting on the U.S. government not defaulting over 90 days. Which, and by the way, if it did, your stocks are going to be in half at that point. So, I have money in money market funds. I think it's a great trade for some people for a certain amount of money.
It absolutely is. With that return that you were getting, I think it certainly also has its place in the portfolio. Mr. Hakimian, I think that's a wrap. Thank you very much, as always, for taking your time to provide us with your very valuable insights. And I very much look forward to talking to you again in October.
Can't wait. Looking forward to it, Elia. Have a good summer.
Thank you, Mr. Hakimian. You too. Bye-bye.